Hey folks, the year is almost over for 2018 and a lot of people are looking ahead to 2019 as they should be in terms of the stock market. Well, I'm just finished creating our chart book for 2019 with a lot of really interesting, if not scary charts for what I think could be in 2019. Very much a trading year ahead, very much like 2018 has been. But what I want to do today is show you one chart, which I think is probably the most important chart, and it's S&P 500 centric. Which I think is actually a great way to look at the not just the U.S. equity market, but kind of give you a global risk asset level levels you can look for. So the main sort of issue I see right now, and I spoke with a lot of investors over the past couple of weeks, professional investors, hedge funds, and things like that in our group, and what I still see is too many people think that we're going to go right back to those highs in the S&P sometime real soon. I don't think that's the case, and so I have a very straightforward chart of the S&P itself to show you how far a potential bounce could go and why it'll be then time to sell or short into that. So that's a bit of a game plan maybe for the first quarter or so of 2019. Let me show you the chart here. So here we are. Okay, so the chart is, like I said, it's very simple. It's just looking at the S&P, if once I could get my camera straight. And what you'll see here is, yeah, well, just the S&P chart, right? Now, what's important to understand is we look at the big picture trends. We always like to do that. So you can see in about early October this year, we had a fairly important break of a longer term trend going back to 2016. The S&P 500 still remains in a long-term secular bull market trend, but this cyclical move here, I do think is over on the bull side, and there's probably more downside. Now, I do think at some point over the next few weeks or so, it is entirely possible that we start to see a very sharp rally. But I do think that rally will be capped somewhere around 27 to 2,800. I know that's a wide range, but let me show you why I think that's the case. First of all, notice where this trend broke. This trend broke just around here, which is about 2780 or so on the S&P. But I think one of the real nice things at this point here is that if you look at the moving averages, and I am really not a fan of oversimplifying things, just looking at a couple of moving averages, I really don't believe in that. But in this case, we do have some really well-defined levels where a lot of things come together. And that area, and I'm going to take my little nifty rectangular tool here, that area of resistance, like I said before, it really is around 2,800 to maybe 2,700. And that is where we have sort of this like spaghetti formation of different moving averages. Let me get me a little bit closer in here. Okay, so that's what we're talking about here is here. You can see the 50-day moving average in yellow, the 200-day in blue, and the 100-day in blue and the 200-day in red. They're all coming together in that zone. Now again, I know 27 to 2,800 is a fairly wide range, but I really have a very difficult time imagining that any rally from here would have a whole lot more upside room than about here. Remember, that's also where that long-term trend line or that 2016 trend line comes in. That's all around here. So I'm a big fan of looking for buying opportunities at the moment. I haven't really put hardly any capital to work just yet because we got the holidays coming up here in just a couple of days. But I do think we have potential to rally at some point very sharply up there. Now, just so you can see what kind of price movement we're talking about, I'm going to take my nifty seems to be the word of the day, measuring tool. And if I go to where the S&P is right now and I measure it up to about, let's say, 2750 on the S&P, which is about the midpoint of that, now we're talking about a 13% rally. That's nothing to laugh at. That's a fairly steep rally. And that's just also one little reminder that some of the sharpest rallies will take place within the context of bear markets. So wanted to give you this chart on the way here as we round off 2018 and go into 2019. I'm still here remotely working in South Florida enjoying the nice weather, but that's actually a good point. I think it's important to kind of wind down a little bit at the end of the year. Don't do any crazy over trading or trading for that matter. It's really important to take some time off. Hope this chart will help you folks. Happy holidays, and I'll talk to you soon.